Picture this. Bitcoin suddenly crashes below $100,000. The fear and greed index just completely goes into a nosedive. Panic is everywhere. Well, today we're going to unpack exactly how you can turn that widespread fear into your single greatest strategic advantage. And that brings us to the one question every single investor is asking themselves right now. With all this panic in the air, is this the ultimate buy signal, or are we all just walking straight into a trap? This slide just perfectly captures the huge disconnect in the market right now. Over on the left, you've got pure, raw, emotional fear. Retail investors are absolutely panicking as prices fall. But then, on the right, the fundamental picture actually looks incredibly strong. We've got positive legislation on the horizon, the Fed is easing up. So which story is the right one? What's really going on here? To get to the bottom of this, we're going to break it down into 5 parts. First, we'll explore the whole paradox of fear. Then, we'll question market sentiment itself. We'll learn how to follow this smart money, understand the difference between market mechanics and emotion, and finally, we'll pinpoint your ultimate edge in all of this. All right, let's dive right in to part 1, fear, greed, and paradox. Why does the market feel one way when the real opportunity might be pointing in the complete opposite direction? It really all comes back to this timeless advice from Warren Buffett. It sounds so simple, right? But actually doing it, well, that's what separates the winners from the more than 80% of retail investors who end up losing money. And why? Because most people simply cannot detach from their emotions. So, who was really behind the panic selling? Well, this wasn't some sign of broken fundamentals. Not at all. It was more like a chain reaction. First, you had institutions taking some profits through the new ETFs. That, in turn, created the liquidity for some long-term holders, the OGs, to finally cash out. And that price drop below 100K, that triggered a massive wave of forced liquidations for all the leveraged traders. This wasn't a crisis of faith, it was just calculated profit-taking. And that leads to a really important question. If the panic wasn't even about the fundamentals, then can we really trust the tools that are supposed to measure that panic? Let's talk about the limits of market sentiment. Okay, so the big one everyone looks at is the Crypto Fear and Greed Index. It's basically designed to take the market's emotional temperature by looking at a whole mix of things: volatility, trading volume, social media chatter, Bitcoin's dominance, and even Google search trends. It gives you a pretty broad snapshot of how confident or how terrified the market is at any given moment. And the results can be, well, dramatic. Just look at this. In our scenario, just 1 month ago, the index was sitting at a 74. Deep in greed territory. But after the crash, it has absolutely plummeted to 24. That's extreme fear. That is a massive psychological shift in just 30 days. So you see an index screaming fear, and the answer seems obvious, right? Just sell everything? Well, not so fast. You have to understand what we call the tourist problem. See, these popular sentiment tools are heavily influenced by newcomers, the tourists, who flood into the market during a bull run and then panic sell at the very first sign of trouble. Their fear is really loud, but it doesn't represent the whole market. It actually makes the data highly misleading. So if we can't trust all the noise from the tourists, who can we trust? Well, it's time to start following the smart money. And we do that by looking at reliable on-chain data. Okay, one of the best tools for this is the MVRV Z-score. Put simply, it just compares the price newcomers are paying to the average price that the long-term holders paid. Now here's what's fascinating. With big institutions now constantly buying and holding, they're creating a really strong price floor. This actually makes the Z-score much more reliable for spotting market bottoms than it is for predicting tops. And then there's the Pi Cycle Top Indicator. You should think of this thing as an alarm bell. It doesn't track sentiment directly, but it tracks the effects of sentiment. It basically goes off when the market has run way too far, way too fast. And its historical accuracy in calling cycle tops, it's been absolutely astonishing. Because you have to remember, cycle tops aren't just technical events. They are psychological. And this gets us to a really crucial point. Let's look at market mechanics versus emotion, these hidden, automated forces that are actually pulling all the strings behind the scenes. This is where we have to talk about something called liquidity hunting. And listen, this isn't some conspiracy theory. It's just how professional markets operate. It's a simple 3-step process. First, smart money identifies where all the retail stop-loss orders are clustered together. Step 2, trading algorithms intentionally push the price right into those zones. And step 3, this triggers a cascade of forced selling, which of course allows the smart money to swoop in and scoop up all those assets at a huge discount. And here's a perfect example of market mechanics just totally overriding emotion. The Chicago Mercantile Exchange, or CME, it trades Bitcoin futures, but it closes on the weekends. So if Bitcoin's price moves a lot over the weekend, it creates what's called a gap between Friday's closing price and Monday's opening price. Now here's the crazy part. The market returns to fill that gap somewhere between 70 and 90% of the time. That's not emotion, folks. That is a purely automated market force at work. Which brings us to the most important part of this whole thing, your ultimate trading edge. And it's not some fancy indicator or a chart. It's about mastering the 6 inches between your ears. I mean, this is a pretty sobering statistic. Over 80% of retail crypto investors lose money. And the number one cause? It's not a lack of knowledge, and it's not a bad strategy. It's purely emotional decision-making. And right at the heart of this is a cognitive bias called loss aversion. It's a quirk in our brains where, psychologically, the pain of losing money feels about twice as powerful as the pleasure you get from making it. This is a trap, and it forces us into making these terrible, reactive decisions just because we're afraid. So how do you fight back against your own brain? Well, you can use this simple 3-question sanity check before you make any emotional trade. First, just ask yourself, am I doing this because it aligns with my plan, or am I just scared? Second, if I didn't already own this asset, would I actually buy it right now at this price? And finally, the big one. What would I advise a friend to do if they were in my exact position? Just that simple act of detaching yourself can bring logic right back into the driver's seat. And that leaves us with one final thought. Look, any market can test your indicators and your technical analysis. That's easy. But a crash tests your discipline. So the real question isn't which indicator you're going to follow. It's which part of yourself you are going to master.